After a very strong calendar year 2024 for the ICE Fund, the March quarter saw a return of minus 6.64% for the fund, and now rolling year the return stands at minus 0.91% net of fees. It's fair to say that the February reporting season in Australia and the March quarter as a whole was held against a real evolving geopolitical backdrop, full stop. This served to increase volatility in the market and across our portfolio. For the rolling 1 year period, and highlighting that we are benchmark unaware, the ASX Small Industrials Accumulation Index returned minus 3.83%, and the Australian ASX Small Ordinaries Accumulation Index returned minus 1.2%. Key contributors to the portfolio during the quarter were GDG. Generation Development have the leading position in sale and manufacture of investment bonds in Australia. And they also have a very strong position via its Lonsec business in the implemented consulting business. Two things happened during the quarter. Firstly, Generation Development recorded really strong results with very strong profit growth across both of those key businesses, Lonsec and the investment bonds business. And secondly, the highly strategic acquisition of Evidentia Group, in effect bringing together the number 1 and number 2 players in implemented consulting. That will bring scale, and with scale, they'll entrench their market position in that sub-segment of the industry. So a very positive development for GDG. Secondly was Temple & Webster, a category killer in furniture and homewares. They reported revenue growth for the half-year period of 24%, and off a low base, 118% growth in profit. They continue to entrench themselves as that dominant player in furniture and homewares in the online segment. And they recorded increases in customer number, increases in customer conversion, increases in average order value. So that business flying, and again, the dominant category killer in online furniture and homewares. A third key contributor was Equity Trustees, or EQT. Again, EQT own financial services infrastructure in Australia through their RE, or responsible entity services, corporate and super trustee services, and they continue to win clients, gain share, and customers in this segment of the market are very sticky. It really is the backbone of many financial service operators and licenses in Australia. And again, EQT continues to demonstrate very strong growth in customers and revenue. And again, their results well received by the market and a strong contributor to the fund. The fund has now entered its 20th year, having started in February 2006. As always, the fund operates and seeks investments in the small cap industrial segment of the market. What do we call a franchise? A franchise is a business with a moat. It has assets that are difficult to replicate, and where we find the customers are sticky. And we look for those attributes, and we look also for a financial return that provides the right risk reward for our customers. We have a 7-year view of valuation, and I'd impress upon our investors how we've continuously applied the same discipline across that 20-year time frame. Some examples of franchises within the fund: Paragon Healthcare, a business we added to the portfolio last year. Healthcare infrastructure. They distribute medicines to doctors, hospitals and pharmacies. They continue to gain share in their categories, and they offer that low cost service to customers. That know-how is what's enabling them to continue to gain share and build that moat around their business. Hansen Technologies provide mission critical software to energy companies, water companies, telcos. And just thinking about those energy companies, billing systems which they provide have become a lot more complex. They need to capture solar contributions, they need to capture battery contributions, and they need to understand different tariffs, EV charging and more. So that's making their customers, who are already really sticky customers, even more sticky and reliant on Hansen. And the AUB Group, they're an insurance broker and network of businesses that surround those insurance brokers. We just find that customers, SMEs, mid-market businesses are really sticky to their insurance broker. There's an asymmetry of knowledge and they really rely on their insurance brokers to provide service, which includes premiums, and it also includes claims. And so what we've experienced over time is just how sticky customers are to their insurance broker, and that builds the foundations of a really strong business. We've built a position in New Zealand listed Port of Tauranga during the quarter. Port of Tauranga is a unique asset. It's a deep water port. It's physical infrastructure that is, very challenging to replicate. Port of Tauranga captures 1/3 of all the imports and exports that move through New Zealand. It's located close to Auckland, the key city in New Zealand, and their customers we find are very sticky, whether they're agricultural products or imports of more consumer goods. Critically, what's happening in New Zealand is pricing power is being exercised. So Port of Auckland has begun to lift prices because they are simply running out of space for their port. Port of Tauranga is following that, and that pricing power will drive increases in profit growth for what is a fantastic asset in New Zealand. It's an asset which is impossible to replicate. The key stock sale during the period was the Redox Group, with their February profit results invalidating our view of the franchise. Firstly, we saw a lift in corporate costs, but secondly, we saw increasing price competition for the importation of chemicals. We had overestimated their ability to resist any price pressure, and as such, our view of the franchise was invalidated and we sold. So why should investors invest in the ICE Fund now? As highlighted earlier, changes that are happening globally are certainly creating a period of dislocation in markets. Over time, we've observed that a dislocation in markets provides an opportunity for franchise investments to differentiate themselves. Businesses with a moat, businesses with pricing power, businesses with sticky customer, and businesses that are less economically sensitive should, in aggregate, deliver better profit growth and more consistent returns for their investors. That's what we look for in the ICE Fund and in the franchise investments which we seek. And perhaps turning the clock back slightly to 5 years ago to March 2020 and, the depths of uncertainty in respect to COVID. When we look back at the 5-year returns for the fund, they're a very pleasing 13% per annum since March 2020, a period we would all probably rather not revisit. But it does highlight, the strength of the franchise investments, the strength of the process, and the opportunity which we see in markets today. Thanks very much.